Earlier on, we speak now to Dr. Azar Jammine, Director and Chief Economist at Econometrix, about that warning not only of developing nations, Dr. Jammine, but of the world at wide. So I'd like to hear from you. Do you share that premonition that, particularly for developing nations, that this current cycle of these shocks that we're experiencing will be unlike anything we've seen since the financial meltdown of the 1990s?
I think it could well be as serious as the emerging markets crisis of the late 1990s. But I think one needs to be quite careful about which emerging markets one is really dealing with. Those that depend on food imports from the likes of the Ukraine or oil imports are likely to be very severely negatively affected. Others who may have benefited, and to some extent South Africa falls into that category, from higher commodity prices for some of the commodities that they produce, are likely to be less negatively affected. But there are those, for example, that have been highlighted, like Tunisia and Egypt and Turkey and Sri Lanka and Pakistan, who are very heavily dependent on imports of wheat and sunflower from the Ukraine, and who are not actually oil exporters, who are being hammered now because they're having to pay so much more for their imports.
So let's take countries on the continent who obviously are commodity rich. Are you saying that they could be shielded, like South Africa, from buying, or rather from selling more than they buy in terms of commodities and the rising prices?
Yes, what really depends is the balance of the commodities. South Africa currently is benefiting from much higher prices for things like, most importantly, coal, of all products that we export. But secondly, things like iron ore, copper, palladium, they've fallen back somewhat compared with where they were a few weeks ago, and also, are not rising as much as they were at the beginning of last year. But relatively speaking, they are more than compensating for the increase in the cost of imported crude oil, or more or less compensating for that. But Nigeria is probably going to be in a similar situation because it is an oil exporter and will be earning more foreign exchange from higher oil prices. But the ones that I mentioned, like Tunisia and Egypt, those northern countries, they don't have those resources, those commodity resources, and are really being negatively affected. And the same thing with Pakistan, Turkey, and Sri Lanka.
Some of those countries, according to the report, have reported, I mean, when you're speaking about the energy and food crises, or the price of wheat, for instance, they're saying that it's gotten so bad that even flour on the black market is unaffordable. Nobody knows how long this war is going to go on for. Could we at some point find ourselves in that position, particularly in the southern parts of Africa, given the fact that we do export things like wheat from the Ukraine?
I would not fly that alarm as substantially for Southern Africa, and especially for South Africa. More than half of our wheat consumption is basically derived from the Free State and the Western Cape. We do have a balance of wheat that we import, and I don't know how much of that we even import from the Ukraine. I think it's from other sources. So, we are very fortunate in being relatively far more self-sufficient food-wise than many other emerging markets. I'm not saying that it's not a serious problem. It's going to affect the average consumer indirectly through higher food prices, because there is the kind of purchasing power parity syndrome, whereby if prices rise overall globally, then your domestic prices also tend to rise, because otherwise your domestic producers would export everything rather than sell to the domestic market. So we are likely to suffer from higher food inflation than we have had in the past. But it's nowhere near as serious as it's a case with so many of those Middle Eastern countries who are totally dependent on imports of their food, their basic foods. The likes of Lebanon imports 80% of its wheat from the Ukraine. It's very heavily dependent and is facing a huge crisis because it's having to pay higher and higher prices to source those wheat imports.
In terms of how precarious our financial situation is as a globe, as you know, the World Bank, IMF have just recently held spring talks, and it says the line of countries approaching them for rescue talks is increasing. You just mentioned some of the Middle Eastern and North African countries that are in trouble. But from the perspective of developing countries, could it see us get more in debt or find ourselves in more austerity directed measures from the IMF?
Much will depend on what happens to all the other commodity prices that we do export. If they hold up well, and the likes of coal, for example, remains at close to $300 a ton, compared with $70 a ton just over a year ago, that will help to insulate us from the full effects of the rise in oil and wheat and sunflower prices. But, I have to mention that we are facing one particular infrastructural stumbling block, and that is we could be exporting a lot more coal were it not for the problems at our port facilities that have constrained our ability to export as much as we would want. But on the whole, we do have that valve and the possibility that we may perform a lot better than other emerging markets. But we've also got a situation where under the current Treasury and Ministry of Finance, we've had a fairly stable situation re-emerging over the last couple of years, and that has provided some confidence. We're not out of the woods by any means, but our revenue collections have improved enormously, and that is helping to compensate and to some extent and prevent us from having to raise our debt levels too severely. So, I don't want to be too pessimistic at this stage yet for South Africa. But in some of the other emerging markets, and we've mentioned some of them, their governments have not been as astute and disciplined as our own government from a financial point of view. And that's why they are in greater trouble and potentially than we are.
But I mean, as you say, we don't want to be pessimistic, but what are the realities that will confront us, particularly soon enough? Are we going to see more capital outflows? We're seeing rising interest rates in the US. We've had no choice but to follow suit. It's clearly getting tougher and tougher for consumers to make any meaningful contribution to the economy.
Unfortunately, Tsepiso, this is a worldwide problem. It's not only confined to South Africa. COVID-19 forced governments who were already heavily indebted to have to borrow still more at huge amounts of money to help provide relief packages. And especially in many industrialized countries, those relief packages were absolutely ginormous. And so many of the world's countries are sitting with government debt levels at unprecedented highs. And with interest rates now starting to rise because of increased inflationary pressures, the world economy is potentially in very deep trouble. And the easiest way to overcome this problem is to throw more money at it. But all you're doing then is kicking the can down the road still further. So there is a real chance of a time of reckoning approaching quite rapidly at the moment. And President Vladimir Putin has simply poured oil to the fire with his invasion of Ukraine, and brought a lot of these problems to the fore far more severely than ever before.
And thank you so much for your time and insights, Dr. Azar Jammine, Chief Economist at Econometrix. We take you